That dream of a place in the sun, it's amazing, right? A little escape, somewhere warm. But here's the reality check you need to hear. When you buy property abroad, that dream almost always comes with a UK tax return attached.
So, how do you actually enjoy that property without a nightmare letter from HMRC landing on your doormat? Well, in this guide, we're going to break down exactly what you need to know to keep everything above board with your UK tax obligations.
And to make sure we're getting this spot on, this whole discussion is brought to you with expert insight from the team at My Tax Accountant. They live and breathe this stuff, so you know the information is first class.
Right, here's how we're going to break it down. We're going to follow the entire life of your property. First, the income tax you'll deal with while renting it out. Then, the capital gains tax when it's time to sell. After that, we'll look at the big picture with inheritance tax. And finally, we'll cover some nasty hidden traps you really want to avoid. So let's dive in.
Okay, let's kick things off with the rental years. This is all about the regular day-to-day tax stuff you've got to think about if you're letting out that foreign property and earning some money from it. Okay, first things first, you've got to get your head around this core principle of worldwide income. Basically, if you are a UK tax resident, HMRC considers your income from anywhere in the world to be taxable here. It doesn't matter if it's from a job in London or a flat in Lisbon, it all goes on your UK tax return. Now, the good news is you don't pay tax on every penny of rent that comes in. You get to deduct your legitimate expenses to figure out your actual profit. Things like agent fees, insurance, and repairs all count. But here's a pro tip. Be careful with travel costs. A quick visit while you're on a family holiday probably isn't going to fly. The trip must be wholly and exclusively for the purpose of running your rental business. Now, that's not all. Here's where a lot of people get tripped up, especially if they've owned the property for a while. The rules on mortgage interest have had a massive overhaul. It used to be that you could just deduct all your mortgage interest from your rent. Simple. But now you can't. Instead, you get a tax credit, which is just a flat 20% of your interest costs. This change hits higher rate taxpayers really hard.
And this makes it really clear. Let's take Gareth. He's a 40% taxpayer in London. Under the old system, that $5,000 in interest would have saved him £2,000 in tax. But under the current rules, he only gets a £1,000 credit. He's effectively paying double the tax on that slice of his income. It's such an important detail to grasp.
Okay, a really common fear pops up at this point. I know what you're probably thinking. Wait a minute, I'm already paying tax on this rental income in Spain or France. Surely HMRC isn't going to tax me all over again in the UK? It's a great question. And thankfully, the answer is usually no, you don't. The solution is something called foreign tax credit relief. Let's look at Siobhan. She made £8,000 profit and paid just under 1,300 quid in Spanish tax. Her UK tax bill would have been 3,200. Now, the key rule is you can claim credit for the lower of the two tax bills. So she claims the Spanish tax amount, which knocks it off her UK bill. The bottom line is this. You don't get taxed twice, but you will always end up paying tax at whichever country's rate is higher. All right, let's fast forward. The rental years have been good to you, and now it's time for the big sale. The moment you sell an overseas property, you step into the world of UK capital gains tax. Now, calculating your gain seems easy, doesn't it? Sale price minus what you paid for it. Simple. But, and this is a big but, there is a massive hidden trap that catches so many people out. And it's all about currency exchange rates. Stay with me. This next point might really surprise you. Let's look at Priya's French farmhouse. In euros, her gain was a pretty modest 20,000. But HMRC forces you to convert everything back to pounds sterling, using the exchange rates on the exact days you bought and sold. So her €200,000 purchase cost her $160,000. But when she sold, the pound was weaker, so her sale proceeds were worth almost $194,000. And this is the crazy result. Her small €20,000 gain has ballooned into taxable gain of £33,600 in sterling. That is a huge difference, created entirely by currency movements. It's what people call a phantom gain. It doesn't feel real, but believe me, it is very real to HMRC. So what's the damage on that gain? Well, here are the capital gains tax rates for residential property for the 2025/26 tax year. If you're a basic rate taxpayer, it's 18%. If you're a higher rate taxpayer, it's 24%. And don't forget, everyone gets a small tax-free allowance, but it's only £3,000 these days. Okay, here's a really important pro tip for you. Was this overseas property ever your main home? If you can genuinely prove it was your only or main residence for a period of time, you might be able to claim something called private residence relief. This can massively reduce or sometimes even wipe out your entire UK capital gains tax bill. You'll need the evidence to back it up, of course, things like utility bills and local registrations. Right. Let's move on to the final chapter in our property's life cycle, planning for the long term. This is all about your legacy, and it brings UK inheritance tax firmly into the picture. Now, when it comes to inheritance tax, or IHT, the key word you need to know is domicile. This is not just about where you live, it's about your permanent homeland. If you are considered UK domiciled, then your entire worldwide estate, including that villa in Spain, falls into the net for UK inheritance tax, which is typically charged at a whopping 40% above your allowances.
And a massive heads up, the rules here are getting a huge shake-up. From April 2025, the old, complicated idea of domicile is being phased out and replaced with a simpler residence-based test. Once you've been a UK resident for 10 years, boom, your worldwide assets are subject to UK inheritance tax. And crucially, there's this new 10-year tail, meaning you could still be liable for a full decade after you leave the UK. This is an absolute game changer.
Before we wrap this all up, let's just quickly look at one final hidden trap that catches so many people out.
See this number? 3%? This can be a really nasty surprise. Here's the deal. Owning a property abroad can actually make it more expensive to buy a place back here in the UK. If you buy a home in England or Northern Ireland while you already own another property anywhere else in the world, you will most likely get hit with this extra 3% stamp duty surcharge. That can add thousands, even tens of thousands, to your bill.
Whew, we have covered a lot of ground today, from income tax to capital gains and inheritance tax. So let's pull it all together and recap the absolute must-know points from all of this.
Okay, here is your final checklist. 1, if you're a UK resident, your worldwide income and gains are taxable here, period. 2, you must declare that foreign rent on your self-assessment tax return. 3, use foreign tax credit relief so you don't pay tax twice. 4, please watch out for that currency trap when you sell. 5, for inheritance tax, it's all about your domicile status, or soon that new 10-year residence rule. And finally, number 6, remember that owning abroad can mean a bigger stamp duty bill when you buy back home.
Look, this stuff gets complicated fast, and the rules are always changing. Trying to navigate 2 different countries' tax systems is not easy. So for professional help to make sure you're getting it right and staying tax efficient, you should contact the experts at My Tax Accountant. You can get them on WhatsApp or by phone at 07854-255-375, or just drop them an email at info@mytaxaccountant.co.uk. So, we'll leave you with this one question to think about. Are you confident that your dream property abroad won't turn into a tax nightmare? If you're not 100% sure, it's probably time to get some advice. Thanks for watching, and if you found this useful, please do subscribe for more practical tax explainers from My Tax Accountant.